Hello, everyone, and welcome to our Fireside Chat series, Emerging Market Reimagined, Quality, Diversity, and New Opportunities with Mawer Investment Management. I'm David Braham, Senior Executive Director of Thought Leadership and Market Intelligence at Institutional Investor. Joining me today is Rob Campbell, Board Director and Institutional Portfolio Manager at Mawer Investment Management. Rob, thank you so much for joining us today.
Pleasure to be here, David.
For investors based in the global financial centers like New York and London, what is the best way to think about allocating to emerging markets today?
Yeah, investors need to ask themselves not just, well, how much emerging markets do we want in our portfolio, but also what kind of emerging markets should we own? And so with that in mind, we've got a couple of recommendations. The first is to prioritize quality. Dispersion between good and bad businesses in emerging markets remains wide and greater than in developed markets. And so companies with durable competitive advantages, sensible balance sheets, a track record of disciplined capital allocation and alignment with shareholders, they've got opportunities to reinvest at high rates of return. Basically, do they provide a good or a service profitably that their customers can't live without? These are all aspects of quality that we think investors should prioritize. The second theme would be, and we've mentioned it in prior installments, but just diversify beyond AI, China, and India. If you look at the top 10 constituents of the MSCI Emerging Markets Index and really break down their revenues and the revenue exposures, surprisingly, the US dollar is largest at about 40%. China's not too far behind at around 37%, obviously a massive market. India is at about 8%, and all other emerging markets represent collectively only 2.5%. In other words, extremely sparse. And so, beyond that, the other thing to note when looking at those biggest constituents is just that most of them are technology related, which implies that their revenues may behave more similarly to those of an already tech-heavy S&P 500 allocation in another part of the portfolio. And so, the recommendation is to think wider. Seek out opportunities in Eastern Europe, Southeast Asia, Latin America, maybe frontier markets. These are regions that offer different policy cycles, different sectors, different types of businesses, different relationships to global trade, and spreading exposure across them can really improve portfolio resilience to any country-specific shocks and reduce the risk that a single regulatory or macro event dominates the performance of the emerging market slate. Anyway, that's number two. Third, adopt a genuinely all-cap approach. Many of the businesses that we tend to find and that best reflect the evolving opportunity set, think about niche suppliers in the semiconductor ecosystem, for example, well, they tend to sit outside the large cap core of standard indices. These smaller and mid-sized companies can offer more direct exposure to domestic themes, and a thoughtfully constructed all-cap portfolio, grounded, of course, in quality and valuation discipline, can really capture this breadth. And then finally, as mentioned in a prior installment, seek out those domestic champions whose fundamental economics are less directly hostage to tariffs and cross-border frictions. So companies whose revenues are primarily local, they might not be immune from those global shocks, but they are often one step removed. You could also take advantage of weaker competition in some of these more fragmented markets. A bit like how every soccer World Cup has some group of death or a pool that's got a bunch of heavyweights. Consider the opposite. Where are the competitive dynamics locally much more favorable to a more dominant incumbent? FPT Digital Retail in Vietnam is a great example. They are a drugstore chain. They compete primarily against an unorganized market, mom and pop operators. And as it expands, as it rolls out more locations, not only does it compound the benefits of scale and procurement and logistics that it has, but it also tends to displace these less former channels. And I think for the customer, offers better breadth of product, better quality of product. And this tends to be a virtuous cycle, all of which without relying on any heroic assumptions about macro conditions. And so, David, to summarize, a focus on quality, diversification beyond headline exposures, genuinely all-cap approach, and a focus on these domestic champions, this all points to a way of investing in emerging markets that, again, less about making a single call on the asset class, more about assembling a collection of resilient, cash generative, and resilient businesses across what continues to be a changing landscape.
Rob, thank you so much, and thank you everyone for watching. Make sure you tune in our next and final installment of the Fireside Chat series, Emerging Markets Reimagined, Quality, Diversity, and New Opportunities with Mawer Investment Management. Thank you very much and take care.